Welcome, everyone. We're so glad you can join us for this on-demand mid-year investor update webinar hosted by JFL Total Wealth Management. Today, we will review the ongoing impact the COVID pandemic has had on the economy and your investment portfolio. We will also look at how this economic downturn compares historically to others and what investment strategies you can leverage to best weather the storm. If you have any questions at the end of the presentation, please contact our office, and we highly recommend checking our webinar library at jfltotalwealth.net/webinars for a downloadable copy of this presentation, as well as other strategic planning videos. Without further ado, let's introduce our panelists for today. Jeanne Kane has an MBA from Duke University and is a certified financial planner. She has extensive experience with analyzing and managing our private clients' portfolios and with developing comprehensive financial plans. Jerry Lynch is a certified financial planner and has been an independent financial advisor for 23 years, working in the financial industry for more than 30.
Welcome, everyone.
Good morning, or good afternoon, everybody. Hope you enjoy the presentation.
We have two topics to discuss today. First, I'll share an investor update, and then Jerry will discuss some ideas and strategies for you to consider. Before we get to the presentation, I'd like to take a minute to remind you to stay safe and please try and stay positive. We're still experiencing challenging times, and as the poet Virgil said almost 2,000 years ago, the greatest wealth is health. And as we get started, I'd like to review that there are 5 key areas of financial planning. These are preservation planning, another way of saying insurance, retirement planning, that's your 401k or an IRA, investment planning, tax planning, and estate planning. So a great acronym to help you remember these 5 key areas, it's PRITE, P-R-I-T-E. So as you meet with us or you listen to our other webinars, if you think about those 5 key areas, which we'll talk about, an easy way to remember them, again, is PRITE. Now, the first half of the year has been a wild ride, and at times it's felt like investors have been on a roller coaster. In mid-February, after reaching all-time highs, the coronavirus quickly crushed an 11-year bull run. In less than 3 weeks, the markets, the S&P 500, it went from an 52-week high down to a 52-week low. That steep decline in stock markets, it set many records, but for those investors who didn't panic, the second quarter reversed that course. And if you were someone who systematically invests into the market, you're probably pretty happy with your portfolio at the end of February. And come March, you weren't necessarily thrilled, but there was a little glimmer maybe of excitement. And that's because you were investing in a down market. For those shoppers out there, this is like buying clothes or buying that big screen TV on Black Friday during those sales. You're able to invest at a deep discount. And as of Friday, July 2nd, that's the midpoint of the year, the equity markets were very close to where they were when they started at the beginning of the year. The second quarter results were strong, and investors who didn't panic were rewarded. The Dow Jones Industrial Average had its best second quarter performance since 1938. The S&P 500 had its best quarterly gain since 1998. And the NASDAQ, that's the index that invests heavily in technology stocks, that had an all-time high during the second quarter. Now, we like to say that panic is not a plan. And investors who panicked and sold their positions in mid-March, well, they may have missed out on strong returns. Say you did decide to get out of the market in the first quarter. Well, one of the biggest challenges that you faced or even facing today is how do you get back in? So the chart that we have here shows the hypothetical growth of $10,000 invested in the S&P 500 in 1980 versus its value at the end of 2018. If you stayed invested that entire time, the value of that $10,000 would have grown to $708,000. If you missed the 5 best trading days, and those are the days that had the largest gains, the value would be about 60% of that $708,000. What if you missed the 10 best trading days? Well, that's a little less than half. And say you missed the 50 best trading days, the value of your investment today, as of 2018, that would be less than 1/10 of what it would have been had you stayed in the market. And the best trading days, they tend to follow the worst trading days. At mid-year, investors faced interest rates on bonds that are extremely, extremely low, gold prices that reached an 8-year high. Now, you go out there if you want to Google what gold prices look like, and look at them over the last 30 years, you're going to see something that looks like a heart rate monitor, like really, really volatile. And it tends to be pretty flat over a period of time, maybe a little bit of an uptick. Relative if you look at the stock market, that's going to grow on average 9 to 10% a year. Unemployment levels, extremely high at this point in time. We are seeing some factory output increasing, and we're also seeing coronavirus hotspots popping up all around the country and also around the globe. The Federal Reserve lowered the federal funds rate in mid-March to a range between 0 to 1/4% of 1%. Now, in Europe, some of those countries are actually seeing negative interest rates. And the Fed has only lowered the rate to these levels twice. First time was during the financial crisis of 2008, and now again in 2020. Now, raising or lowering of interest rates, that's a tool the government uses to be able to maybe speed up or slow down the economy. Think of interest rates as brakes on a car. So say the economy is growing at too fast a rate and it's heading maybe towards inflation. Well, then the government's going to raise interest rates, effectively putting the brakes on and helping slow the economy and slow down that growth. The opposite is true if the economy is starting to slow down. The Federal Reserve maybe will let off the brake by lowering interest rates, which will help to jumpstart the economy. And these rates are expected to continue for the foreseeable future. And in the June session, the central bankers really projected the economy was going to shrink by 6.5% in 2020. But then in 2021, they're seeing growth of 5%, and in 2022, a 3.5% gain. Both are well above the economy's long-term trend. Now, say you're someone who feels that they really want to be conservative right now. What's the potential true cost of being in a safer investment? Well, let's take a look here. We look at this bank money market rate, and this came from the end of June of this year, 0.12%. On a 12-month CD, that was 0.4%. So for many investors, these lower interest rates may not help you reach your goals. Now, the rule of 72 is a simple way to determine, how long is it going to take for me to double my money. You take number 72, divide it by your interest rate, and that equals the number of years it will take for your money to double. Say you put your money in the CD. At this rate, that 0.4%, it's going to take you 180 years for that money to double. If you invest in the stock market, and maybe you earned an average, say 7%, you would see your money double in 10 years. Now keep in mind that on average, the stock market is going up between 9 and 10% per year. And even though we're seeing volatility right now, stocks can and should be part of a diversified portfolio. Now, although the stock markets aren't the economy, many experts believe that the stock market is an excellent economic indicator for the US economy. Their thinking is that the equity markets, they reflect how well the companies that are listed, how well they're doing. Typically, if investors are confident, they're going to buy stocks. So let's take a look at how the economy was initially affected by the coronavirus and how it's recovering. As this chart shows, after a decade of mostly growth, the first quarter's gross domestic product, that's the value of all goods and services that are produced across the economy, that was a negative 5%, the worst that was seen in well over a decade. For the second quarter, the GDP figures dropped by 32.9%. That's the steepest decline in more than 70 years of record keeping. And how we recover from here, that's crucial. We always feel that a knowledgeable investor is the best investor. So let's quickly review some more of the more common economic recovery scenarios. They're usually referred to as the V, the W, and the L shape, because that's what their graphs look like. A V-shaped recovery, that's a sharp decline followed by a quick rebound. A W-shaped recovery, that's what you've known or you've heard of as a double dip because it's got 2 drops. And an L-shaped recovery, that's a sudden plunge and a little more of a fitful recovery. And time will tell which path we're on. Past stock market performance is not a predictor of future performance. However, as this chart shows, starting at the end of World War II, bull markets have been far more robust than bear markets, and they've lasted longer. While every market decline is unique, over the past 70 years, the average bear market has lasted just over a year and resulted in an average loss of about 33%. By contrast, the average bull market has run for 6 years, and the gain has been 279%. Please keep in mind that for now, volatility in the equity markets has reemerged, and it's here to stay for a while. After several years of limited volatility, in the first half of 2020, investors had seen more days where the market moved up or down by 2.5 percentage points or more than almost every year since the 2008 financial crisis. One of the questions we get asked a lot is, what's going to happen to the market this year? It's a presidential election year. As I said a couple times, on average, the stock market goes up 9 to 10% a year. In the last 23 elections, that's since 1926, the average return during those election years, well, it's been 9.5%, smack dab in the middle of the average. There have been 4 of the last 23 election years, only 4 have had negative market returns. The first one was during 1932, that was in the middle of the Great Depression. The next was during the start of the World War II, followed by the dot-com bust and the financial crisis in 2008. There are other factors, larger economic factors that influence the markets, not just the US presidential elections. So does having a Democrat or Republican president, does that mean that the markets are going to increase or decrease? No, it doesn't. Again, the performance of the stock market has more to do with what's happening on a macro basis. So let's take a look at George W. Bush. He's a Republican, and his policies were pretty pro-business. But yet while he was doing office, the markets decreased by almost 4.5%. And that's because he had to deal with the dot-com bust, 9/11, and the 2008 financial crisis during his tenure. When Barack Obama was president, he was following that. He was in the recovery from the 2008 financial crisis. So he benefited from the markets increasing, and he happened to have, during his tenure, almost a 15.5% gain. As for what happens in the 2020 election, it will have more to do with how we're able to combat the coronavirus globally and how economies recover. Jerry, I'll hand it over to you now to talk about ideas and strategies that investors can explore.
All right, well, listen, Jeanne, thank you. Again, first of all this information you're getting today is coming out of our newsletter. You should be getting a newsletter once a month on many of the topics that are happening out there. And I think it's good just for you to go through that, make some comments in it. And when we sit down and have a review, we could bring it up and have a good conversation on things that are concerning you. If you have some family members or friends who'd like to get a copy of that, please send us the information and we'll make sure they get them a copy. I'm a firm believer that everything that happens that's bad out there, there's something that corresponds as being, good that comes out of the situation. The example I would give is interest rates. Right now, interest rates are at virtually zero. If you are a retiree and you're living on a fixed income, that's one of the worst possible things in the world that can happen to you. But also, it's one of the best possible things in the world if you're looking to go out and buy a home. The interest rates are lower, you could buy a better home, you could buy a bigger home. And it also means for many of the retirees that are thinking about downsizing, they're going to get a good buck they're going to get a good benefit from selling their properties because they could sell at a higher price because the cost of buying that property is lower. There are some other opportunities that are out there. Now, first of all, if you're subject to required minimum distributions, that means you're age 72. This year, all the required minimum distributions were suspended. So you're not forced to take money out of your IRA if you don't need it. That's very important. If you've already taken out money, you could put it back through the end of August, and you will not be hit with any income tax for that distribution. Right, so it's like you never received it. Now, another thing that you may consider is that you could also do a Roth IRA conversion with whatever you were going to historically do in terms of distributions, and basically make that so the income in the future is tax-free. One of the reasons why I like this is many of you, if I send you in a required minimum distribution, you don't need the income, and you're taking that money and you're sticking it into a bank account. So I literally created a taxable event for nothing by not taking that distribution. Again, if you don't need it, then this way I'm not hitting with you on any income taxes that are not necessary for you in this time. The other thing that you may want to think about is some other opportunities. Again, the market's been incredibly volatile. Because of that, your portfolio has changed radically. And just to kind of walk you through what we did so far this year, in 2019, we had an amazing year in the stock market. The stocks were up anywhere from 20 to 30%. Great year. What that meant was, coming into January of this year, our stock allocation was substantially higher than what it should have been. So in January, what we did is we rebalanced, which is basically just putting it into the original allocation, and we took down the stock allocation. And for many retirees, we actually took it down another 5 percentage points. In March of this year, as Jeanne was saying before, the stock market was down over 30% in a 4-week period of time. What we did at that point is we rebalanced back in, now using the money that we had moved over to bonds, put it back into stocks, so we were buying at a discount. And we also got out of a lot of corporate bonds and state bonds and went more into treasuries, where we felt it was a little bit more safer place. But this is something that, again, taking a look and rebalancing your portfolio is really important to do in a volatile situation. The other thing that you should be thinking about is Roth IRA conversions. For a couple of reasons. When I watch TV at night, and I see everybody saying we're going to do money for this and money for that and schools and all that kind of stuff. Again, I support doing what you have to do to get through this, but my reaction is always the same. Who's going to pay for this? And the only way that you could do this is that you have to increase taxes. You have to increase the amount of revenues that are coming in here. Long term, I'm very concerned about how much national debt that we have, and to the extent that we could do Roth conversions today, because the Trump tax program is less expensive for a majority of the people out there in the United States. So if you're doing Roth conversions, you're paying the rates at today's rates. If they go back to the old rates next year, which is possible, then we've captured today's lower rates. We're not forced to take minimum distributions in the future. And again, if for some reason this money goes to our children in the future, they will also receive an income tax free. So make sure that we're taking advantage of today's lowest rates. A couple other things that you may want to think about is, I joke about it, but I don't want to die in a skydiving accident, so I'm not jumping out of a perfectly good airplane. I think it's important that you take a look at how much risk you have in your portfolio, and you see, is it in line with what I'm willing to accept in terms of pain? Now, again, if you have a long period of time before you get into retirement, you could be a little bit more aggressive with your money. If you have a shorter period of time, you may want to start taking some of the chips off the table and making sure you're not being that aggressive in terms of your portfolio. At certain points of your life, you have to change your mindset. You have to go from a mindset that I'm trying to get the highest rate of return to I need to protect what I have so that I could get through retirement and be there for the future. So a couple of ideas to think about. So when I take a look at money, I'm going to organize it in 3 different ways. I'm going to organize it in short-term money, mid-term money, and long-term money. And let me walk you through what that means. So if I'm sitting with somebody who's retired, one of the first things I want to know is, what do we have in guaranteed income? What do we have in Social Security? What do we have in pensions? How much does that come out to? How much money do we need, and how much money do I need to generate on an annual basis to be able to have the lifestyle that they have become accustomed to? So I'm going to take a look at how much income is being generated from the portfolio, and I'm going to take a look at how much money do we have in short duration bonds and cash to basically pay that person out, and see how many years do I have before I ever have to sell a stock at a discount. And that's incredibly important, because I never want to have to sell a stock at a discount. I want to make sure I allow that stock to go through the market cycles, get reasonable rates of return, and I could do that by protecting cash flow, which is the most important thing for a retiree. So that bucket one, I want to make sure I have usually between 10 and 15 years that I have set aside in income that's being generated from the portfolio and short duration investments before I ever have to sell a stock at a discount. And that may be 20% stock or something like that. Now, the second bucket is really designed from 5 to 10 years out. And it's really just designed to take a moderate level of risk. And more importantly is that bucket 3 is designed for 10 years plus. Now, again, the longer I have to remain consistent in the stock market, the better my odds to get consistent returns. There was a great hockey player called Wayne Gretzky, and they asked him why he was successful in hockey. And he said, most people skate to the puck. I skate to where the puck is going to be. Now, if I know reasonably 3 out of every 4 years the stock market is going to go, and if I take a look at historically how the stock market rises, I'm not overly concerned about short-term volatility. What I'm concerned about is that if I remain consistent in my approach, I'll have reasonable growth over a period of time. And by allowing me to protect my cash flow, get reasonable growth and long-term growth, I can achieve my investment objectives. Now, there's a great investor named Benjamin Graham, and you may not be familiar with him, but he was Warren Buffett's teacher. He was a professor, I think, at NYU, wrote a book called The Intelligent Investor, and he's basically a value investor. And he's got this great line that I think a lot of people should really think about. An individual investor should act consistently as an investor and not a speculator. One of the questions people ask me is, again, I'm going to do something short term. I had a phone call today where somebody's thinking about buying a home. And what should I do with my money? And my response is stick it in the bank. If you have money you need within the next 5 years, you should not be giving it to me. You should not be putting it at risk in the stock market. Protect that. The money you give to me and to our firm, you should have a 5, 10, 15-year horizon that we're doing something with that allows us to get reasonable rates of return. We're not getting in and out of the market. We're using long-term efficient strategies to get from where we are today to where we need to be in the future. Now, again, when we look at investing versus speculating, there's a couple of different things we're going to take a look at here. Number one is when we're looking at investing, it's generally the act of buying and holding an asset for the long term. When I'm looking at somebody's portfolio, I don't care what your 1-year performance was, even if it was negative, because that's part of the overall process. I care if that is a good long-term investment. So for example, the S&P 500 was down 34% in a 4-week period of time. Was there anything wrong with the S&P 500? The answer is no. It's a good fundamental investment. It's got very low fees. Over a period of time, it's going to do fine. I'm not going to get in and out of it. Now, speculation is something that's a little bit different. Speculation is you're going in, you're taking a lot of risk, and you're making a bet in a very short period of time. I don't speculate. I'm not a believer in speculation. I think that over a period of time, when you look at Las Vegas, you look at Atlantic City, that is built on people speculating. And if you love those buildings, it's because people are leaving their money there. They think they're going to get in and out, and they have some knowledge that nobody else has. But every money manager in the United States has either passed up on that investment or have already purchased it. So again, when we're looking at things, we're looking at long-term strategies to help people get to where they need with the highest level of success. Typically, the most successful investors think and act for the long term. The longer you have to do something, the more consistent you are in your approach. I think that is what's going to give you financial success in the future. Any of the people that we work with that are financially successful today, it's not because of one thing. It's not because they bet on Google or Microsoft or whatever the case may be. They might have owned some of that stuff, but it was that they lived below their means on a systematic basis. They saved through all different types of market conditions, and they basically invested and let their money grow through all different types of conditions. And over a period of time, they became financially successful. That's how this stuff works. So I think when we look at a couple different things. What are we going to do next? Now, again, I know a lot of you are very scared. We have an election coming up. We've had a heck of a lot of volatility. We still have issues with the coronavirus. And again, what are we going to do? And my point would be the same thing. Do what Wayne Gretzky did. Where is the puck going? The puck is going up. Over a period of time, the stock market is going to continue to do what it does, which is go up at a rate of 9 to 10% a year. That's kind of what it does. Historically, that's what it does. Short term, it may be volatile. And as long as we protect our cash flow and make sure that we have a good level of liquidity, if we do need it, then it could allow our money to go through and basically recover and get through this. If you had gotten out of March of this year because of how bad it was within a 4-week period of time, you would have locked in a 34% loss. Because you remain consistent, you're pretty much whole where you are right now. So again, if we have a long-term plan, we have to maintain long-term strategies, and we shouldn't be overly concerned about short-term situations. And while this is some large short-term situations, it's still a short-term situation. We got to remain consistent, and over a period of time, we're going to do fine. So a couple of takeaways we have from today. Number one is, first half has been crazy. Again, it's been crazy in a variety of different ways. It's been crazy because of COVID. It's been crazy because of the market up and down. And it's crazy because we got an election coming up and we got a lot of politicians who hate everyone. And it just creates a lot of volatility that's out there. Again, that's going to happen. And I think we have to be able to deal with it. And it's reasonable that the volatility is going to continue for some period of time. Now, again, I love investing in a volatile market. I hate having money in a volatile market, but over a period of time, the dips in the market are when you get the highest rates of return. If you were investing through March of this year, you actually got the highest rate of return for the year is the money that you invested in that 1 4-week period of time. The other things that you have to take into consideration is your health is your top priority. I mean, the bottom line is do whatever you can to stay healthy. Wear a mask. Don't be around people that are right in your face. Don't be in situations that could get you sick. You know, you could always recover from your money. You can't recover your health. That's really, really, really important. And I think the last thing that we have to do is focus on their personal goals and call us when you got concerns. You know, definitely this is a very emotional time for people. It's emotional because of the sickness. It's emotional because of the volatility in the market. You know, especially if you're retired, it's something that really concerns you. Now, one thing I take pride in is in the 30-something years that we've been doing this, I've never had one retiree have to go back to work in 30 years. I've had people go back to work because they were bored. I've had people go back to work because they wanted to have more fun, but I've never had anybody go back. So I think the strategies that we have in place, especially for retirees, work very, very well. And I think you need to take that into consideration. So a couple of the things that I think are important is that we will continue to have regular communication with you on a regular basis. Again, I mentioned the newsletter. Please go through this. If you have friends that you think you should have on there, or your kids especially, make sure they take advantage of it. We also have a full video series, which I think are very good for children as well if they're learning about investing, buying their first home, whatever the case may be. We're going to continue to have frequent discussions on this, and I want to continue to do reviews on a systematic basis. I love looking in your eyes, asking you a question, and seeing that you're hesitant about something that tells me I need to probe more. I love seeing and finding out what your concerns are so I can help you feel more comfortable with your future. And to the extent that we could continue to do this, it's really important, especially in times like this. And again, our financial reviews, we're going to be looking at a lot of different things. Number one is we're going to be doing tax reviews towards the end of the year again, because I want to see, based on the election, are there things we should be doing between now and the end of the year. We're going to continue to monitor the investments that are out there and potentially make changes like we did this year, but they're not going to be knee-jerk changes. They're going to be changes that make sense based on the conditions that are out there. And we're going to continue to monitor the situation. If there's anything we think you need to be aware of, we're going to send you out that information so that you could understand it. And if you have questions, we could speak about it. And I think that's really important. Finally, I just want to take a moment to thank everybody for their time and support during this time. I know it can be very stressful to go through this, and we really appreciate your support from myself and everybody on our team here. We work very hard to make sure that we're, providing you with the best service that we can, and we want to continue to do that. So again, thank you very much for all your support, and we look forward to working with you. Thanks again.
Thanks, Jeanne and Jerry, for a great mid-year investor update and potential strategies for the coming months. As Jerry mentioned, if you have any questions or would like to speak with us about your personal financial situation, please contact our office. See you soon.